Hello and good afternoon. I welcome you to today's Hoppa Trading Spotlight webinar on Friday. It's the 15th of January, 2021. And I think this is my first webinar this year within this series. So Happy New Year to everyone. I hope you had a great Christmas holiday and a great New Year's Eve. And I hope that 21 won't be that, let's call it volatile as 2020 has been. We want to, today look at a very, very interesting topic. In fact, we want to look at, one second, please. Okay. We want to look at gold and mining stocks in this context and answer a question, Outperformer in 21, and probably beyond that. How comes that I'm positive for gold, especially mining stocks here in this context? That's what we want to answer within the next 40 minutes around. What's probably of high interest is why gold has seen such a difficult start into the year. I think this is probably a sign of, probably some will say, probably weakness. The same is also true for mining stocks. Mining stocks have also not performed that extraordinarily well, but still, I think there's a potential bullish case for gold and also for mining stocks. And we want to dig deeper into this here within the next minutes. First of all, let's have a look here at today's agenda. So first of all, we want to do, or I want to give a short recap of the Corona peak. What happened there? It's nearly 1 year ago now, but still, I think it's it's of certain value for us here to dig deeper into this and wonder what happened there and what this not just means in terms of the Fed balance sheet and U.S. federal budget, but especially what it means for the U.S. dollar and also for gold. And what we then want to do is we want to point out the obviously positive correlation between gold and mining stocks and use a great tool here from the Admiral Markets Supreme add-on, which you can download for free on the website, admiralmarkets.com. Just check out the top platforms and there you can then download this Supreme add-on just for your information. So then we want to give some thoughts on mining stocks and also give some investment opportunities, respectively vehicles you can use. Admiral Markets is a multi-asset broker, which means in this case, you have the chance also to trade physical stocks, so gold mining stocks, for example, but also you have the chance to trade ETFs, for example. There's one big mining stock, gold mining stock ETF, it's the GDX. We want to have a look at the top 10 holdings here. Especially we want to point out why mining stocks are of high interest here. So what fundamental drivers could drive the price significantly higher, even though current performance seems a little subdued compared to its peers. That's me, by the way. So my name is Jens. If you're here for the first time, I'm in the financial industry now for something a little more than 15 years. I started out as an employee with a bank, training with a bank. After that, or during that time, I found out that trading is the place I wanted to be. And now I found out that if I want to make my way into trading, back then I was thinking about making a great career somewhere on Wall Street. I quickly found out that it's necessary to study something quantitative. So that was kind of the transition phase, let's call it. And I studied mathematics and economics. And beside that, I then was a trading assistant. Working as a trading assistant was my first job as a trader. In fact, at a stockbroker, quite big stockbroker here in Germany. And so that was then the starting point of my career, really on a professional trading desk. And after some time, I then made it on my own. So I went out and I, beside my studies, traded the markets and learned everything, in fact, from scratch on my own, especially when it comes to risk and money management. What do I mean by that? Well, if you're working for a professional trading desk, then you have someone who calculates the risks for you, and you're trading with someone else's money. So it's really not that kind of emotional thing, let's call it. And that's something completely different, and many will definitely agree here when listening to that. But now I'm located in Berlin, Germany, and I'm working together with Admiral Markets now for over 2 years as a partner, and so I'm really happy to be here. And I just enjoy giving you some insights in the world of trading in this case. By the way, Abner Markets, the broker behind here at this webinar series. So a broker, in fact, I would say a leading provider of FX and CFD financial services in general, financial service solutions provider here, and in this industry for nearly 20 years now, and highly regulated. In fact, the great thing about Abner Markets is certainly that you have a broker here which has offices in over 20 offices around the globe. And why is this of interest? Because you can be really sure that if you have a question around any financial products, account related, whatever, service related, you have a high chance of reaching out to someone who is speaking your language. And I think, based on my experiences in the retail industry back in the bank nearly 20 years ago, I found out that there's a high level of trust involved, and it starts, in fact, with speaking to someone in your native language. It's just something different if you have the chance to talk to someone in your native language. So feel free to check out the highly competitive offering also in terms of spread commissions when it comes to Abner Markets, abnermarkets.com for further information. There you also find the Supreme add-on we want to have a look at here then in a few minutes. And now let's start. Let's have a look at the Corona peak, the short recap I want to give here, and answer the question, what happened there? So some of you probably have seen and probably remember the time back then with this enormous volatility, in fact, and the massive demand the US dollar has seen during that time. And the main reason for that was, in fact, and that's probably something many do not have on the agenda, it's the reserve ratio, we call this. And this delivers the answer, what went wrong there and why probably the current system is broken and we have really no other chance, case of the Fed in this case, but also when it comes to the government, we have no real other chance than to see the Fed continue buying not just treasuries, but pump US dollar into the system to keep the system alive, in fact. And in this case, there's no other chance then, in fact, for the Fed to provide more liquidity, else this whole system collapse. So why is that? Well, let's have a look here at the reserve ratio. It's the so-called percentage of a commercial bank's deposit that it must keep in cash as a reserve in case of mass customer withdrawal. Okay, so therefore, an example to make things easier here. Let's imagine we have a sheikh here, and this sheikh sells oil, for example, for, let's say, 1 million USD. So I'm buying from this sheikh oil and pay him 1 million USD. And now he has the money and he deposits this money at his bank. Let's say he's located in London and he deposits 1 million USD there. So what the bank now can do, and usually does, is it can, if the reserve ratio is 1 to 10, in fact, it's even lower than that, they loan out 900K and only keep 100K in his account. So now let's assume that the bank loans 900K to a guy who buys wood, let's say from a Russian wood seller, which then this guy, the Russian wood seller, who is also paid in US dollar, deposits as his bank in Moscow, for example. So spare bank, something like that. And now we assume that a crisis hits, like the one we just seen around the Corona virus peak and the lockdown, and people not really knowing what to do, where to get money from, cash flow drying out, but still having to pay the rent, in fact, or invoices, whatever. And now the sheikh goes to the bank and says, hey, bank, I deposited 1 million here. I want to have my money back. The thing is that the bank, in this easy example, obviously does not have 1 million available, just 100K, because they loaned out 900K here. And to the guy who bought the wood in Russia. By the way, the Russian bank in this case does the same. So we are building, in fact, a scheme which is highly leveraged, let's call it. So And then the bank has to make sure that it gets the money from somewhere. So the demand to get US dollar rises, which perfectly explains why the demand for USD during a crisis like the one we've seen in March explodes, in fact. And you see initially a massive capital inflow into US dollar, respectively, a rising US dollar compared to the euro, compared to the JPY, compared to pound sterling, and so on and so forth. And this is, in short, very simple, roughly speaking. This is what happened in short, what happened in March with the US dollar demand shooting through the roof, resulting out of the massive USD funding shortage. Since USD denominated liabilities of non-US banks stand currently, in fact, at over 13 trillion USD. So just imagine, we have a fat balance sheet. You probably have seen the developments there, and we have a fat balance which just passed the $7 trillion mark. The thing is that before the crisis hit, the Fed balance was somewhere around something else, 4.5 trillion or something like that. So they really increased. They increased the balance sheet here by something like 60 to 70% within months. And the reason for that is because the whole system we are living in, our whole economic financial system, needs USD. If the USD is, there's a USD shortage, once, let's say, the shit hits the fan and we really have to finance our liabilities, we have a strong demand for US dollar, which then potentially results in these sharp swings, also in classic so-called safe havens like gold, for example. So why is gold selling off initially here when it comes to this Corona peak? It's very simple, because people need US dollar, so they are selling their gold, future gold in this case. So to get cash and to get USD, they are currently running out of, and yeah. So as a result, then the Fed started printing US dollar, and not only delivered to US banks in this case, but also to fund the massive deficit to stabilize the US economy. So currently, for example, so we are running this webinar now in January 21. Currently, there's now talks starting when it comes to another relief package. For example, the new current president-elect Biden, once you listen to that, let's say in February, then we have the 46th president of the United States, Joe Biden. He is talking about increasing the stimulus, the money he hands directly out, for example, to US citizens, from $600 to 2,000 USD. We've already seen such a handout of US dollar freshly printed by the Fed last year. It was 1,200 USD, if I'm not mistaken. And so, well, what we currently need is US dollar, and they need to be printed. And this is exactly what the Fed will continue to do. So what we should expect is that here on the left hand, the massive balance sheet expansion will continue to increase. So in fact, that's a screenshot I took from a website completely for free. It's tradingeconomics.com, that you can find massive and tons of fundamentals around the globe from any country you can imagine. In this case, I have taken the Fed balance sheet, the central bank balance sheet screenshot here from the US in this case. And you can see here, it's slightly below 7 trillion when I took the screenshot. So far, we already passed this number. And then there's also another thing here. This is a screenshot I took from, I just hope that I have no, unfortunately not, I'm sorry. The source, it's potential must follow, I'd say. It's from a wealth manager from the Netherlands, Jerome Blokland is his name. And I took a screenshot here, and you can see it at JS Blokland in this case. So if you're on Twitter, I highly recommend following this guy. He had a screenshot several months ago, I think, which shows the US federal budget in this case, and the explosion here of debt in the US, which should be expected to continue. So this is the red bar on the right, which should be expected to continue to rise. So which means that the debt should further explode in the US to finance this economic downturn after the Corona lockdown. And so what we've currently seen, if you look at this, I mean, this chart goes back till the 1930s in this case. So this is the highest federal budget deficit since the end of World War II. And so then you can really start to understand where the problem arises from, and how this has to be financed somehow. And in this context, you can now already see somewhere a light at the horizon, in fact here, when it comes to where the money comes from and what this usually means for gold. So yields should stay low, while debt will rise, while the central bank balance sheet will rise. This is usually something you probably have already heard of, a potential bullish case you can formulate for gold. And so this is exactly what we now look at here in the following slide. Not really. In fact, we will have no text here in this case. But I tried. This is something I look forward to prepare once we have our webinars this year. Not to write too much, but instead work with pictures, which make probably the whole situation even clearer, and underline the thoughts in this case for gold. So what we have here, this is also a chart from Jerome Blokland in this case, by the way. So what we have is we have in blue US 10-year Treasury inflation indexed yield. It's inverted. What is inflation indexed? It's like the real yield. So what we have here is you have usually, if you look at 10-year US dollar treasuries, for example, so 10-year T-notes and the yields on them, what you have is you have a yield then, but this does not mean that this is the yield you can expect to enter your account, or by which your account will grow. At first glance, it will. Let's say it's 2% and you deposit 100,000 here in T-notes, and it's 2% per year. That means that after 1 year, you have 102,000. The only thing is, do you really have 102,000, or is it lower than that? Certainly it's lower, because now you have to deduct inflation here. And this is where inflation index comes from, respectively real yield comes from. Because if, let's say, inflation is, for example, 2%, you have an increase of your overall account size from 100 to 102, but you have to subtract 2% here again, so 2,000, because inflation is eating your potential profits, your yield here in this case. And this is exactly what happens here. And what we have in black is gold. So it's the gold price. And what you can certainly see at first glance, there's a positive correlation. That means if inflation rises while yields are not rising, continue to stay quite low, this is currently what we're seeing. I mean, or at least there's an expectation around this, that this will happen. Because what you usually should expect is the more money you print and flood the markets with, as the Fed currently does, as the ECB does, as the Bank of England does, the Bank of Japan, Swiss central bank, and so forth, and so forth. What you usually should expect is that rather sooner than later, there will be kind of an inflation, at least an expectation that inflation will rise, while yields, in fact, will stay low. So that means that real yields in this case will drop. Respectively, the blue line will continue to rise because it's inverted. So, which means that this is usually a positive sign for gold, because usually what you argue is that you say, well, if I buy gold, there's no real cash flow, there's no yield. It's just like, it's some metal, yellow metal, you put it in your safe and that's it. And it's not there's no yield involved, no cash flow generated or something. The money is not working, but it's like it's stored within this yellow metal piece of metal here, you just put in your safe. And that's a fair point. But the thing is, even if the yield is zero here and there's no cash flow involved, the thing is that once you have here in this case, more and more negative real yields, the more attractive even an investment in something like a zero yield asset becomes, right? Because here you have zero yield, so it stays the same. It's no inflation, which is eating your profits, your yield, or your wealth, or something like that. But it just stays stored within this piece. Okay, so and this is why this chart makes perfect sense in this context, because if this inflation indexed yield is rising, which means that real yields are dropping, the more negative these numbers get, the more attractive gold becomes, and this is exactly what here results in this positive correlation. Then, so usually you see a huge divergence in this case, but since it's inverted, you have a positive correlation here. And what we've seen, by the way, here, and this is very interesting to nice to note, especially when looking at the developments right at the start of this year. What you can see is that the black line dropped quite heavily here, while this blue line stayed, in fact, at its multi-year highs. And why is that? It's a good question. No one can really answer that. Me too, by the way. So, I mean, there's now potential theories arising that probably there's a kind of a manipulation taking place from, in this case, the paper gold market / the banks who are behind the comics, for example. So there's physical delivery. Since gold is a good, or it's a metal, it's a precious metal, which you can't create out of nothing. The problem is once here, in this case, the physical delivery crosses a certain threshold, well, you can imagine that the comics in this case will get trouble to get their hands on enough gold to deliver it. What would result in a massive loss of trust into the whole system in this case, into the comics, which makes it likely that there's probably some kind of manipulation taking place, trying to put pressure, at least on the paper gold market. Once you look at physical gold, for example, you will see if you have some kind of physical gold dealer somewhere in your country, in your city, you will see that prices stay quite elevated. And this is because these physical prices can't be manipulated, while the paper gold price could be manipulated. So, but this is just one thought, probably you have heard about. What we want to look at here now is, and this is where our main topic here comes into play in regards to mining stocks. By the way, 1 second, please. Yes, yeah. So exactly. If you have any questions, please feel free to ask them right here. By the way, also, if you watch this video here, this webinar, as a recording on YouTube, first of all, please leave a thumb up here. That would be really, really nice. And in addition to that, if you have questions, please feel free to ask them right below this video. I'd be more than happy to answer them. In addition to that, please also feel free to check out the Traders Yard community. We have a community where you can ask all your questions, trading-related questions you might have around positions you currently have on, and all that, and so forth, and so on and so forth. So please feel free to check out the service over there too, and use the chance to interact directly, not just with me, by the way, but also with Paul and with Marcus in terms of your trading. And so now, obviously, what I just did was, in fact, let's come back to gold and mining stocks. What I already did was I created a quite solid picture for gold, I'd say. So if you sat down in a minute at home, thought a little about it, you will probably wondered several times. You probably have wondered, where will all this lead? So the more money they print and the more money they pump into the system, and they flood the markets with liquidity, currently you see a creation of an asset price bubble. No, I mean, look at stocks, for example, shooting through the roof. A Tesla, all these massive runs on the upside, growth titles which are shooting for the stars, let's say. And so now the thing is that this has been or happened already in the past, and usually it was the end of the paper money as people knew it back then, and then there was a new paper money installed, some kind of new system. But what stayed over the last thousands of years was certainly gold, and the importance of gold. So it's definitely makes sense to have gold in your portfolio. Still, sometimes you might say, well, having gold, precious metals in this case, yes, it's I understand the point, and from a diversification perspective, it certainly makes sense. But, and this is the thing, there's no cash flow involved, as you already said. And in addition to that, it's also some kind of, let's say, not difficult, but it's also sometimes probably, what's the word for this? Somehow dangerous, let's say. Yeah, probably it's the right word to put it that way. So dangerous to have gold at home, and there's always the risk of being the victim of a thief, for example, or something like that. Mining stocks are getting really interesting in this context, and the reason for that is because obviously mining stocks usually profit from a rising gold price. But what we can see here, and this is the add-on, I've taken this snapshot here from with the Admiral Markets Supreme add-on, the correlation matrix. What you can see here, what I did is, in fact, I have gold, and then I put ABX, NEM, and GDX below that. And you can see here high positive correlation. So we are looking here at the last 500 days in this context. And now you wonder what is ABX, what is NEM, and what is GDX. So you will see more clearly why I put exactly these. What's the word for this? The German word is Kürzel, so the short version of the stock in this case. ABX, it's a short for Barrick Gold. You can check out upmarkets.com and type in under the equities tab to check out which equities are available for trading. ABX is Barrick Gold. NEM is Newman, in this case, Newman Gold, or Newman Mining in this case. And GDX, it's the gold ETF, the FANEC gold ETF here. And you can see a high positive correlation of these markets. So a high reading here says if one rises, the other should follow suit, which means nothing more than if the gold price rises, usually you should expect ABX, NEM, and also the GDX rise too. And why that is, this is something we have here in the next slide in this case. So it's the FANEC Vectors Gold Miners ETF. And this is a screenshot I've taken from, I think it's Yahoo Finance. I'm not really sure, to be honest. I think it's Yahoo Finance. And you can see here why I took Barrick Gold and Newman in this case, Newman Corporation, NEM and ABX. You can see it here. Those two are the top two holdings, in fact, of this GDX, FANEC Vectors Gold Miners ETF. And they, in combination, have more than 20%. So there's also other companies like here, for example, Franco-Nevada, Newcrest Mining, Wheaton Precious Metals, for example. They are, if I'm not mistaken, I think they have a clear focus on silver. There's also a silver ETF, SLV. So, for example, you have Kinross. However, so you can now see I took the two biggest shares or holdings within this GDX here in the slide before, and they're also the most liquid shares, in fact, so highly and massively traded, in fact, in physical form. And now what we have here is I've put this in a picture format, let's call it, and you can see the same ticker name. Thank you so much. That was exactly what I was looking for. No, I disagree. I disagree with that. So before we just look at this picture, there's a very interesting question or from remark from Ovidius. I hope that was right. Who asks, who has a question, will Bitcoin, cryptocurrency, replace gold? I don't think so. The reason for that is if someone asks me, I have to say that I really love the technology, blockchain technology, everything behind Bitcoin. I really love that because it's, for me, as someone who studied mathematics, for example, this is just it's a great way to create something. The whole system in itself is very, charming. I think it's also a nice way to say that. But the thing is, we depend, especially when it comes to crypto currencies in general, we highly depend, for example, on our laptops or the internet in general. So that sounds ridiculous, but just imagine if I was a bad guy and I would just shut down the internet and just say you don't have access, or you don't have access to certain websites anymore. That's probably enough. You don't need to shut down the whole internet. You just say, well, I know that, for example, this and that crypto exchange has this and that URL, you just shut it down. So there's no trading taking place anymore. You, for example, prohibit the acceptance of cryptos as a vehicle to pay whatever service you wanna buy. You just prohibit this. You highly regulate it. That was something which Ms. Lagarde, the ECB president, mentioned in an interview. I think 2 days ago. I think that was on Reuters. I had to check now. I have to check my Twitter account. I retweeted this. That was an English article, and she was making fun of Bitcoin. She was talking about the funny business which is taking place in Bitcoin right now. I think this is a very fearful statement, or it should. If I was, let's call it hodling, so I have Bitcoin in my portfolio, I'd be scared to death to hear something like that. Look at the FCA, who just had a blatantly blunt warning. If you invest in cryptos, you could lose all your money. And this is a regulatory body in the US. I'm sorry, in the UK. Sorry, not the US, in the UK. So if these regulatory bodies, if someone like President Lagarde from the ECB says something like, is talking about funny business in a very arrogant fashion, I think this is a clear sign that you're really at risk to lose all the money because it's purely speculative. If the governments around the world say you're not allowed to pay any invoices here in Bitcoin, any services, something like that, or if you offer that opportunity, you're selling a service and someone can pay in Bitcoin, you're out of business. So we won't allow you to do any business here. I think this is a big risk, and this is something which is probably becoming a certainty rather sooner than later. I could really imagine regulatory bodies / governments around the globe will continue to make it more difficult / prohibit just trading cryptos in general or paying invoices. This is something, well, we've seen that, by the way, in gold. This is, you might probably wonder, is that really realistic? Well, there was in the US, for example, it was forbidden to hold gold in physical form during the starting from the 1930s, I think. We had the same here in Germany during the Third Reich, for example. You weren't allowed to have gold. It was you could pay a high price. Well, they will kill you. They were killing you if you had gold. That was something they usually did with someone not following their laws in this case. So, and this is something we already know that this could happen. In case of gold, having it in a physical form, you have the chance to, somehow hide it somewhere, make it very simple. In case of Bitcoin, I think this is very difficult and not really achievable in this case. So that's one of the reasons why I'm very careful when it comes to cryptos in general. That doesn't mean that I'm not convinced and that I don't see the overall elegance of this product and the sense. And I highly recommend understanding, studying blockchain technology. Still, I think there are some risks involved. You definitely have to take into account. And currently, look at around the globe, lockdowns, human rights, respectively, the rights of people are heavily restricted. So who says that this won't be the next step, that they probably restrict the access to something like blockchain, or not blockchain technology, but Bitcoin or something like that. So that is something which is really also which is currently running through my mind when looking at the markets and the current developments we currently see. So let's have now a look here. So this is a German website, by the way, where I have this chart from. Let's have now a look here. How comes that I'm very positive when it comes to mining stocks? 1 second, by the way, I just have to have a look here. Okay. Wow, what a crazy. So I'm currently looking at a stock which is completely going crazy. It's a 3D. So that's a stock which has run up over 30% yesterday. I'm just wondering what's going on there. But let's come back to mining stocks. So why are mining stocks of high interest? And I have prepared something here. This is from Klatt Capital in this case. It's asset manager / hedge fund, if I'm not mistaken, with data from Bloomberg in this case. And here in this context, looking at oh, wait, let me just 1 second. Let me just. Okay, so it's Klatt. And Klatt, they are very bullish on gold, but also on mining stocks in general. And why, especially on mining stock? That has to do with the fact that as a fund manager, so let's assume you're a hedge fund, for example. What you usually have, the problem which you usually face, is in fact that you don't really you can't buy physical gold, but you have to find other ways to invest the money of your clients in this context. And so that's one of the reasons why hedge funds here, in this case, like Klatt, are currently, I'm sorry, why they are currently, 1 second, I just have to. Okay, now it's perfect. So that's one of the reasons why they're also focusing on mining stocks, and why they're, if they are bullish on gold, why they usually formulate a quite positive case in this case for mining stocks in this context. And so what they find out nevertheless is something, and I've written it down here. They made a very, very nice and a very interesting they found out something really nice and very interesting in this context. So what they found out is that here we have the so-called free cash flow yield they were looking at. And once you looked at mining stocks over the course of the last 20 to 30 years, in fact, you had usually an investment within a company which was burning through its cash reserves, in fact. So, and you can see this here. So what you have is the free cash flow yield, and it was negative, nearly going back till 1995, but it turned positive in the 2020s here, in fact. So what you have here is a free cash flow yield, which gives you an idea on the financial solvency ratio, which compares here the free cash flow per share, if you're investing in a mining stock, which gives you an idea of the free cash flow per share, and what the company is expected to earn against its market value per share. And so what you do then is you calculate the ratio by taking the free cash flow per share and divide it by the current share price. And that means, sounds very academic. In fact, it says something very simple. The higher the free cash flow yield in this case, the more likely a company is generating enough cash to easily satisfy its debt and other obligations, including dividend payouts, and thus becoming more attractive to long-term, especially investors, mid to long-term investors, and thus becoming very interesting for funds who target investments for their clients in safe havens, let's call it, or inflation hedges like gold, but they can't really buy physical gold and then place it in their accounts, but instead have to go for another investment form, another asset in this case, which is the stock, which is highly positively correlated to the gold price itself. And that's what we can see here. So this is, they call it a new era. So they are very bullish on that. They're very, very optimistic. I'm a little more, especially based on the current developments we've seen here in the market in general, especially when it came to gold. But what you can clearly spot in this case, what you can clearly spot is that it's a massive switch in terms of profitability when it comes to mining stocks here. And this is something which is all in all creating an overall quite bullish case for mining stocks, and underlining why an investment, if you do not plan to invest your money in gold physically, because you say, well, I'm not seeing any for example, any positive cash flow, for example, or something like that. So what you usually then see here in this context is where what you're seeking is an investment which generates a cash flow. And currently we're seeing such a development taking place here in this case in mining stocks. And thus it becomes really attractive, I think, to at least shine a light on an investment within this investment form, or in taking this as a vehicle to trade in gold, generating a cash flow, paying dividends and that stuff. So let's sum this up. First of all, the reserve ratio, let's come back to this, caused the massive volatility here, and especially the strong rise in the US dollar when the Corona panic, let's call it, hit in March. Resulting out of the US dollar funding shortage, in fact. And since USD denominated liabilities of non-US banks stand at greater than 13 trillion USD, 13.3 trillion, in fact, and the need to fund the massive deficit here to stabilize the US economy, the Fed will likely, not just will likely, but has no other choice then to continue to flood the markets with liquidity, respectively USD, and balloon its balance sheet further, and I think we have a great chance to reach an amount greater than 10 trillion USD, which should be expected. There's still some upside when looking at the GDP until they are potentially running out of ammunition, which is one of the reasons why, for example, when looking at the euro, respectively at the ECB, people here from the European Union should start to really be scared to some extent, we can say. That has to do with the fact that the GDP here is potentially dropped below 10 trillion euro, while the ECB already increased her balance sheet above 7 trillion too. And so now you can see that in case of a GDP which is we can say north of 21 trillion USD, in case of the US economy, well, they have some room to go here on the upside, while the ECB is potentially running out of ammunition probably to fight the economic downturn, and especially once here the insolvency and bankruptcy rate shoots through the roof, especially in Germany. Banks will probably European banks in general would probably run into deep trouble, and thus it will. Here in Europe, I see no other chance. So we looked here at the Fed and the developments there. What we can also certainly do is we can have a look at the ECB, and probably here the situation is even more tense, and that means nothing more than there's also another potential bullish driver for gold here in this context, probably especially when it comes to the euro, and then after that, probably when it comes to USD. All in all, still, what we see is positive positive case for gold, and thus a positive case for mining stocks. And so let's come back here to the summary. So flooding the markets with liquidity, what does it mean? Well, it means that as a result, real US yields will continue to drop, which means get more and more negative, favoring not only continued US dollar weakness, not necessarily against the euro. That's something this is something different. You probably have wondered how far can this rise go in the Euro USD, which just passed 120 and went up to 123. I have a quite bullish picture, at least short term, up to 125 probably from 130, especially if US yields drop below 10-year US Treasury yields drop back below 1%. The thing is that once the ECB runs out of ammunition and banks start to face some heavy headwinds due to the corona pandemic, that then the euro could see a massive sell-off, even though the US dollar stays weak, given all what we just presented here. But the euro is even weaker in this context. But what I definitely would say is that we have definitely a bullish case for gold in both cases, and thus in mining stocks. And so here in this context, gold mining stocks as ABX, so this is the ticker symbol for Barrick Gold, or NEM, so Newmont, but also ETFs. If you want to be more diversified and not just put all your eggs in one basket in this case, and buy one stock, but buy a basket of stocks in this case, an ETF like GDX, for example, which is highly positively correlated, all of them, ABX, NEM, and also GDX, as we've shown, they are all highly positively correlated to gold. And given their recent switch into positive territory here in terms of its free cash flow yield, it's a very attractive alternative, respectively, addition to your portfolio to hedge against the devaluing US dollar, to hedge against inflation, and potentially also generate a quite attractive cash flow in this case. Yeah, so that's it around mining stocks, and in this case on, oh, I'm sorry. This is a little unfortunate. So usually, so now we have the complete slide. So this is on Paul's webinar. He will be here on Monday, 18th of January, same time. If you registered for the webinar, and if you're already here now in the live event, then you don't need to do anything, but you just get the webinar registration, respectively the webinar link. You get it sent directly to your inbox. While if you watch this on YouTube, then you have to head over to outmarmarkets.com and then go there to the education tab, webinars, and there you can register for the Trading Spotlight webinar series. Again, 2 p.m. London, next Monday, 18th of January. Paul will talk about how to trade false breakouts. In this case, including what is a false breakout, are there a threat or probably an opportunity? And then he will certainly and surely also answer the question how to trade them. So yeah, check out Paul's webinar on Monday. Here is the details on how to contact Admiral Markets, global@admiralmarkets.com as an email address. Also, as I already mentioned several times, head over to YouTube. Probably you're here, right, on the YouTube recording. Subscribe to the Admiral Markets YouTube channel. There are plenty of webinars. And as a highly regulated broker, here's the risk disclaimer at the end. So that's it from my end. So happy trading. Watch your stops. Have a nice weekend. Talk to you again next week. And see you soon. Have a nice, happy weekend.